Alrighty, it is 6 p.m. Eastern Standard Time in New York City, May 1st. David Edwards, President and Wealth Advisor with Heron Wealth, my colleague Buff Parham of Parham Associates. Everybody always wanted to know who you were, Buff, so well, I'll mention it again. You're a Stanford graduate, many years in production and sales for NBC, Telemundo, and then how long have you had your own business teaching communication?
10 years.
10 years.
And that was Univision, our competitor.
Univision.
Is Telemundo.
Got it.
Yeah, it's okay.
So, so Buff and I have been working together for probably a year, maybe 2 years at this point. And if you've been a long time fan of these webinars, I have gotten better, to say. So, Buff, why don't you do a little bit of introduction, and then we'll jump into tonight's webinar.
Well, David, since our last session, it seems that things are going from bad to worse. For starters, are you seeing any clear indicators that we're heading into a bear market?
Yeah. So the official definition of a bear market is a 20% pullback in the S&P 500. And we last saw a bear market between March and May 2020, not even 2 years ago, when COVID first reared its ugly head. And that was the sharpest, deepest bear market in history. It was also the fastest recovery from a bear market. By July, kind of back to break even, and the market took off and gained another 40% over the next 2 years, and hit an all-time high in the NASDAQ in December, S&P 500 in January. Since then, the NASDAQ down 22.7%, so that counts as a bear market in the NASDAQ. And then the S&P 500, as of Friday, down 13.1%. Most of that fall took place in April, down 9% in April. And we'd actually been at that level earlier in February. Market rallied back through the beginning of April, and then just yeah. That's technical. Yeah. That's a technical expression. So so why? What's going on? There's this weird disconnect between what the stock market is doing and what the U.S. economy is doing. And we're reminded in those circumstances of a famous quote from Paul Samuelsson, an economist, who said that the stock market had predicted 9 of the last 5 recessions, and we've actually updated it. It's more like, has predicted 18 of the last 11 recessions. So the stock market does things that are not necessarily correlated with the real economy. So here's what we're looking at in the real economy. Since January 2021, the U.S. economy has added 7.9 million jobs. That's more jobs in the Biden administration than in the entire Trump administration. The U.S. unemployment rate is currently 3.5%. That's 0.1% above the post-war low. More interestingly is what's happening within the jobs market. Real wages, which were pretty stagnant ever since 2009, actually bumped up sharply this past year. And all of my clients that own businesses have the same complaint. I can't get people without sharply increasing salaries. In fact, one client told me that his wages were up 90% in the last 2 years. Wow. That's quite a jump. And he can raise prices somewhat for his business, but he's got to absorb a lot of that jump in the unemployment rate. Consumer demand remains high, especially around housing. Housing prices are hit a record high, and January have leveled off a little bit. Probably will come down with rising interest rates. Corporate revenues and earnings are solid for the most part. There was a big miss in Amazon yesterday on Friday, and the gist of it was they've gone from a very high growth company to an average growth company. And that stands to reason. Amazon now owns all of U.S. retail. Where else are they going to go? Yeah. But yet investors are frightened. And the reason why they're frightened, because this Ukraine war, it looks bad. And I think it's going to go on for 10 years.
And what about the likelihood of a recession?
We'll get to that in a minute.
Okay, all right.
I'm kind of I'm listing all the things that are going right and all the things that are going wrong, and then we'll come to a conclusion about the recession. So yeah, so when we talked about the Ukraine war a month ago, I said there were 4 scenarios. The first scenario is that Russia overruns Ukraine in a couple of days. That didn't happen, obviously. The second scenario is where we are right now. It becomes a horrible slog of just missiles and shells going back and forth for potentially years. 10 tens, if not hundreds of thousands of Russians and Ukrainians will die unnecessarily. You know, Putin's kind of like the angry boyfriend who's like, if I can't have you, nobody will. And you know, what's interesting is that the Americans and the NATO allies seem to be much more assertive now, sending heavier weapons, more weapons, trying to keep the balance intact. Scenario 3, we talked about the Russians, the Ukrainians push the Russians out of Ukraine. It's a possibility, right? They already successfully pushed them back from Kyiv. Now we're still down around Donbass and Crimea, and that's a lot shorter distance to Russia, a lot easier for them to fight. Now the Ukrainians have to stretch from the west. And then there's scenario 4, which is that Putin gets really annoyed and starts launching tactical nukes. And that was a risk a month ago, and it's still a risk now. And I've been trying to think, you know, what could Biden say to Putin to get him to back off those nukes? And maybe he says, well, listen, if you go nuclear, we invoke Article 5 of NATO, which is that it's a common threat to all nations. Now it's no longer Russia against Ukraine, it's Russia against all of Western Europe, Canada, and the United States. So so that's something to be concerned about. But you know, we were in Afghanistan for 20 years, Iraq for 10 years. The Russians were in Afghanistan for 10 years. So these wars can go on, and economies can go despite that. The pandemic is not still over. There's actually a little uptick in infections. It seems to me like everybody I've known who successfully avoided the COVID for the last 2.5 years is getting it right now. I haven't gotten it yet, but I'm pretty sure it's going to happen. So that's the bad news. The current strain is very infectious. The good news is it's not lethal. All of my friends who've had it in the last month have said, yeah, it was rotten for a couple of days, but I didn't have to go to the hospital or anything. So that pandemic is still out there, but you know, New Yorkers are back to whooping it up like they always do. Energy prices quadrupled since January 2020. They were artificially way down. Now they're artificially way high. Backed off about 25% from the immediate reaction to the war, but they're going to be high for a while because energy markets are disrupted. Real food prices are at the highest level since the 1970s because Ukraine and Russia together make up about 30% of world wheat production. The Ukrainian farmers can't plant right now. There's tanks and shells in their fields. Even if the Russian farmers do successfully plant, I'm sure they will, they have a new problem in the fall. Bulk carriers won't be able to get to Russia to load up because of insurance issues or fears of the war. So it doesn't really affect the United States so much, but places like Africa and Asia that are dependent on this Ukrainian-Russian breadbasket are really suffering right now. Interest rates are definitely heading higher. The Fed raised rates 0.25% so far. That was not much. That's still a long way from the 2.25% we had in January of 2020, right before COVID. And then it's even much lower than the 5.25% that prevailed in 2006, 2007, right before the financial crisis. So in my mind, it's not that interest rates are finally going up, it's that they've been way low for way long. And the mortgage market, the mortgage bankers haven't waited at all. Mortgage rates were 2.65% 18 months ago. Now they're 5.1%, just a big jump up. I've had a lot of conversations with clients about should they sell their houses. I'm like, yeah, sell now, because you know every time interest rates go up 1%, the affordability of your house goes down a couple percent. And then lastly, what's really weighing on everyone's mind is the level of national discourse has simply sunk to total idiocy. There's a great line I saw in the Atlantic recently. The last decade has made us stupid.
Great article, by the way.
If Twitter disappeared from the face of this earth, I would be the happiest person around. I would. Anyway, so you add that all together. Are we plunging into recession? What does this bear market mean? Are we good with our stock positions? I think we're going to be fine on a recession. As I said before, the Fed is raising rates, but it's still way lower than historic norms. Inflation is going to be with us for a while. The raising rates won't do anything about energy prices. Raising rates won't do anything about food prices. Raising rates won't fix the supply chain. China has a big surge of COVID right now and shutting down Shanghai and whole cities. Well, that disrupts factories. Raising rates will cool off the housing market. You won't see prices rising so fast, but we still have a significant undersupply of affordable housing. So rents are soaring right now. And anybody's trying to get an apartment in New York City right now, it's just completely out of luck. There's 35 people applying for every one apartment that becomes available. So instead, we'll muddle through. We'll just muddle through.
But do you think that? Oh, go ahead.
Yeah, go ahead.
Possible that at least the prices can level off. Let's forget the idea of them going down, but can they just level off for a while?
Yeah, they can certainly level off. Where we are on energy prices, for example, we've seen this level before in 2007, 2006, 2008. Where we on food prices, yeah, we've seen it back in the 1970s. I don't think labor prices are coming down. You had a situation, particularly where if you look at wage growth by quintile over the last 20 years, so you've got high earners, and then you've got people that are well off, college educated, and then people that are sort of high school educated, and then not high school educated, and a lot of the blue collar jobs that required a basic high school education don't exist anymore. Even if you go work in a factory now, you're no longer bashing metal, you're operating a computer terminal, and then a robot is actually doing all the work. So, so for 20 years, real wages came down for the bottom, three quintiles of the American population, while for the white collar class, the professional class, they went up dramatically. And now you actually see a little bit of inversion where the professional class folks are seeing their wages level off, but meanwhile, people work at Starbucks or work in, a company that repairs autos, right? Fixes fenders, or it makes food, right? Those wages are up sharply, and I'm actually fine with that. I've always said that it's not realistic. Forget raising a family, trying to take care of one person on $10 an hour. Even $15 an hour seems too low these days. But if it's 20 bucks an hour, then you might be able to get by. And by the way, if your business can't survive without $10 labor, you don't have a real business.
Exactly. The Fed, it seems as if they undershot and now they're trying to overshoot. Let's say that the market continues to spiral downward. Do you think that Powell might pull back a little bit, or is it just pedal to the metal?
No, the Fed, we talked about the Fed at our year-end webinar, and they had the same problem that we had. Is this inflation temporary or is it permanent? And I always think back to the 1970s when inflation was up huge, and by the time I was trying to get a job in the early 1980s, we had the Volcker recession, and as they jacked Fed funds to 14% to kill off the economy. And there's a difference between inflation then and inflation now. And the Fed actually looks at two kinds of inflation. They look at sticky inflation and volatile inflation. So sticky inflation is things like how much car insurance goes up every year.
Right.
It goes up at a pretty steady rate. And right now it's going up at a pretty steady rate. But then you've got volatile inflation, which is around food, around energy, around clothing, around manufactured goods. That's all over the place. And back in the 1970s, both sticky and volatile inflation were marching together. Now sticky inflation is going sideways and volatile inflation is going up. But we've already seen energy pull back by 25%.
Yes.
And then food prices will kind of work their way out. So, maybe the report we had 2 or 3 weeks ago was peak inflation, 6.9%. Maybe it'll be 5.5 and then get back to 2%. So we just don't know. I've often remarked that inflation and wars go hand in hand. So during World War II, huge inflation. During the pandemic, huge inflation. We had the war on the virus. Well, now we have a war in Ukraine. That's very inflationary. Ukraine is kind of the Detroit of Eastern Europe. They make a lot of parts that are shipped west to be assembled
Yes.
in Germany and Poland. Well, that's all disrupted right now. And you know, you can raise rates all you want, but if you can't get stuff, inflation is going to be high.
Well, based on all that, what's the best course of action for investors?
Yeah. So let's look at three broad asset classes: U.S. stocks, international stocks, and bonds. So U.S. stocks had a pretty good run through January 2022. They've pulled back 13%. Seems like a big deal, except that we have a pullback like that on average once, like 2 times in 5 years. And we have a bear market on average once every 5 years. So we had a bear market 2 years ago, doesn't really count. Maybe we have a bear market coming up later this year, maybe we don't. Mm-hmm. But interestingly, my overall forecast for the end of the year is staying the same. At the start of the year, I said, you know, I see company earnings going up, company revenues going up, that's good for stocks. I see interest rates going up, that's bad for stocks. Net, we should finish out the year between, you know, up 6 to 8%. Well, you know what? The earnings are still strong, the revenues are still strong, interest rates are proceeding like we expected. Why? Because the Fed told us what they were going to do. So that still leaves me thinking that stocks will be up 6 to 8% by the end of the year. To get from where we were on Friday to 6% would be a gain of 22%. And we've seen that before. We saw it just 2 years ago, where the market sold off 35% and then rallied back 50%, all in the same year. So U.S. stocks will do their thing. International stocks are struggling right now. It always seems like when the U.S. gets a cold, the rest of the world gets the flu. Another thing that's happening is because rates are rising in the U.S., money is flowing from other currencies to the dollar is rising. That makes the value of investments overseas worth less. But we always keep some exposure there, typically 10% in developed markets like Australia and Japan and Western Europe, and then another 5% in emerging markets. And then we have the bond market. Bonds are getting killed this year.
Yep.
You know, we anticipated this. We deliberately brought the maturity of our bond investments short. In the bond world, it's all about interest rates and maturity. So if you have a bond that matures in the next year, it is affected very little by changes in interest rates. And if you have a bond that matures in 30 years, it's greatly affected by changes in interest rates. And we deliberately came back to the sort of the 3 to 5 year band. Even so, you know, just getting pounded on people selling all kinds of bonds. And we're just going to ride that out. The flip side of bond prices falling is that yields are rising. So 2 years ago, we were getting 2.5% on our bonds. Then we were getting 3%. We were getting 3.3% in January. Now we're getting 3.95%. So we're just going to wait patiently, take this year as a write-off year in bond investments, but expect a higher return in 2023 and 2024.
In the real estate, you said sell.
Real estate is interesting to look at. Real estate hit an all-time high in 2006. It was the real estate bubble. It was the era of the no income, no job. What is it? Ninja, no income, no job. Yeah, mortgages and mortgage-backed securities and CDOs, and the market fell about 35% from the peak to the trough. The trough was in 2009. From 2009, it doubled, and the rate of acceleration increased the last 2 years because rates went so low, mortgages went so low, prices went high. Well, now rates are coming up, so prices are going to level off a little bit. And so that's pretty good news for anybody who owns a house and is thinking about selling it. You won't get quite the top tick, but you will get, the best level ever. It's not so good for people that are trying to get into the housing market for the first time. There's still a pretty brutal, down payment to get past, and then those higher rates are going to make the affordability less as well. So
qualifications.
If we see the impact of Fed policy anywhere, we'll see it in the housing market, and that's, I think, a good thing, kind of killing off a bubble that was in process.
Any questions from the audience? I don't see them on my screen.
Let's take a look. It might be one of those nights where everyone wants to go out and play. We'll take about another minute or so. If anybody has a question, wants to shoot it in on the chat function or the Q&A. Oh, yeah, we got a question. Do you see a change in the supply chain issues? Just when you think it's safe to go back to the water. So first we had terrible impact as COVID first appeared and ripped through, not so much in China. China actually aggressively tamped down COVID in the very beginning. But we actually get a lot of stuff also from places like Vietnam and Cambodia and Malaysia, and it just completely ripped through those countries, Bangladesh, and busted things up. And then we had average Americans stuck at home. So, well, I can't go out to dinner or go see a movie, so I'm going to buy more stuff. So then you had more stuff coming from overseas. All the ports got clogged up. They went up for 24-hour scheduling in the port of Los Angeles. And then you had yet another problem in the United States. There's not enough trucks, not enough truck drivers to get stuff where you want it to be. So lading rates have all gone up. And then you got that boat stuck in the Suez Canal. Remember that? There were stuff coming for Christmas 2021 that will be sold in Christmas 2022. Finally got that unstuck. And then it seemed like we were about to maybe get some break on the supply chain. And then the Ukraine war came along and busted up Western Europe. And now China is facing a pretty severe COVID wave, and they're locking everything down. Shanghai is their biggest manufacturing city, and it's completely locked down right now. So my opinion is just be patient. If you want to have a car this year, if you want to buy a car this year, it's going to cost you a couple $1,000s over list price.
Yep.
But if you can wait till next year, the supply chain should work its way through. Like, do you absolutely need to get sneakers 24 hours from Amazon? I do, but maybe not everybody does. So anyway, supply chain will continue to be disruptive, and then they'll work with it. I think the other thing that might happen is that American companies might say, we need to shorten our supply chains up a little bit, bring some manufacturing back to the US. We'll see. Question, are you investing or holding cash in the near future? On Friday afternoon, I fired up one of our computer systems and ranked all of our portfolios by available cash. And there were 26 portfolios out of 200 that had more cash than usual. And all of those went over to Lucas, our portfolio manager, to invest this week. And if anybody wants to give me cash right now, I will invest it right now. And then the next question was, for people of retirement age, would you be selling into any rallies to reserve cash before any recessionary pressures on the financial markets? No, I won't. We always take the position that money in stocks is 5-year money. And for our clients who are retired, we have a waterfall system where if we target, let's say, 65% of their portfolio should be in stocks and 30% should be in bonds and 5% in cash. Well, when the markets rally in general, we'll sell some stocks, trickle that money into bonds, trickle the bonds into cash, pass that cash out. But we don't get crazy and start changing the asset allocation. It's almost like we're sailing across the ocean and we had a storm. We don't change course. We might batten down the hatches, whatever. The passengers might be getting sick, but in general, we have a well-built boat and we understand how oceans work and storms work, and we're just going to keep going forward. In the 26 years I've been running this firm, maybe it's even 27 at this point, I've never once had to cut someone's retirement draw because of stock market volatility. As long as the Russians keep their nukes in the silo, I will continue to do that.
Speaking of Russia, I see another question here. It says, I was reading about declining demographics in Russia, which will limit their ability to wage war for longer than we think. If that's true, what does that mean for the markets?
Yeah. So a number of countries in this world are actually facing demographic decline. Japan is one of them. Russia is another one. And people cannot remotely understand how large Russia is. It's 11 time zones. The United States is 4 time zones. One of them is Hawaii and Alaska. So you could take all of the United States, lay it Russia, put another one there, and still have room left over. But it only has a population of 140 million people. The US is 350 million. Western Europe is 450 million. Ukraine is 44 million people. And for the last 20, 30, 40 years, Russians have been drinking themselves to death or emigrating. And so now they need to call up the standing army in Russia is about 400,000 troops, and then they have conscripts as well. And they threw 250,000 of them into Ukraine. The mortality was 15,000, 20, 25,000 so far. Nobody knows for sure. We won't find out for a while. But some of the units that were around Kyiv lost 30% of their manpower and kind of like crawl back to Russia to regroup. So they actually will now do an annual conscription and hit young men ages, let's say 20 to 24. Those will be thrown into the war with no training. Oftentimes those conscripts are used for driving trucks and doing maintenance, whatever. Well, you need some training to do that, right? Driving an SUV is one thing, driving a missile carrier is something else. Yep. And then they've got a propaganda issue. So that, right now, Putin controls the state media in Russia, and most Russians get their news from television, and they believe that this is a special military operation against the Nazis in Ukraine that eat babies and kill Russians. Yeah. Well, yeah, but now every little village in Ukraine is going to have one young man killed, 2 young men killed, 3 young men killed. And that's going to really create problems with the dialogue of the propaganda. Another thing that happened is that a lot of the technical class of Russians just got the hell out of Russia by any means possible. They took a train to Poland, they flew to Dubai. So you got this big brain drain. Well, how do you run a modern economy when all your smart people are leaving? So Russia at the end of World War II was the second largest economy in the world, half the size of the US. Now it's, I think, number 15 or so behind Italy and Spain and Germany. That's not impressive. They're going to keep sliding down the ranks. So anyway, we're coming up on exactly 6:30. This was a good session, Buff. I hope you have a pleasant plan for next week. What are you going to do next week?
I'll probably squeeze in a little bit of biking, a little bit of golf, and of course my practice. So it'll be a good mix.
Yeah, myself, lightly scheduled next week. So anybody feels like they want to have a one-on-one conversation, jump on the phone, jump on my calendar, and book an appointment, or just pick up the phone and call me. Good night, everybody.
Stay the course.
Yep. Bye-bye.